Welcome back to our Junior Accountant Training Series. Today, we're diving into an explainer that's in absolute rite of passage, your very first month-end bank reconciliation. We're going to walk through this together, just like we would if we were sitting side by side at the controller's desk. As a newer accountant, this is hands down one of the most important tasks you're going to perform. Really, it's the ultimate test of a company's financial accuracy. In our previous modules, we covered cash coming in, Module 02, and cash going out, Module 03. But the bank reconciliation, this is the ultimate independent check that bridges those two worlds. It's how we confirm that everything we've recorded in our books actually matches reality. If the cash in and cash out don't tie perfectly to the bank, well, we have a problem. So here's our roadmap for today. We'll hit the independent cash check, walk through the 4 common reconciling items, break down the step-by-step process, look at required journal entries, and wrap up with some absolutely critical controls and risks.
All right, let's jump right into part 1, the independent cash check.
At its core, a bank reconciliation is just comparing 2 records of the exact same cash. On one side, you've got the bank's record, what the bank statement says is in your account. On the other side, you have the company's record, which is what your general ledger says. Now, here's the kicker. These 2 balances are almost never identical at any given moment. And honestly, that's totally normal. Your job, your mission as the accountant, is to play financial detective. You need to explain exactly why they differ to ensure every single dollar is accounted for. If you can't fully explain the difference, something is wrong. It could be an error, a missing entry, or even potential fraud.
Moving on to part 2, the 4 common reconciling items.
First up, we have deposits in transit. Basically, the company recorded a deposit in our cash receipt system, but the bank just hasn't processed it yet. Think about it like this. You deposit a batch of checks late on a Friday afternoon, right after the bank's daily cutoff time. The company's books show that cash immediately on Friday, but the bank won't process it until Monday. So your book balance is temporarily higher than the bank balance. Nothing is wrong here. It's purely a timing difference. Next, we have outstanding checks, which is kind of the exact opposite. The company issued a check to a vendor, lowering our general ledger cash balance. But the vendor hasn't deposited it yet. The bank literally has no idea you wrote that check. It's essentially a secret between you and the vendor until they finally cash it. Because of this lag, your book balance is going to look lower than your bank balance. Item number 3, bank fees and charges. You know how banks love to deduct monthly service fees, wire fees, or non-sufficient funds fees right out of the account? They do it instantly, often without giving you a heads up. Since those fees hit the bank account right away, your general ledger balance is going to be temporarily out of sync and higher until you actually see the bank statement and record those deductions. And wrapping up our top 4, we have interest income. Just like fees, the bank credits interest directly to your account at the end of the month. But we haven't recorded this income in the general ledger yet because, well, we don't know the exact amount until we review the bank statement. We can't just guess, so this leaves the bank balance temporarily higher than the books. All right, section 3. Let's look at the step-by-step reconciliation process. This process follows a pretty strict structure. Step 1, you start with the bank balance straight off the bank statement. Step 2, grab your book balance, straight from the general ledger. Step 3, adjust both sides for those timing or missing items we just talked about. And step 4, well, step 4 is the moment of truth. Your adjusted bank balance absolutely must equal your adjusted book balance. If it doesn't, you've got an unreconciled difference and you cannot close the period until you hunt it down and investigate. Let's put this into practice with a simplified October month-end example. So we start with completely different balances. The bank says we have $48,200. The books say we have $49,440. Let's fix that. On the bank side, we add a $3,500 deposit in transit from October 31st and subtract $2,100 in outstanding checks. Boom, adjusted bank balance, $49,600. Now the book side, we add the $210 of interest the bank gave us and subtract a $50 service fee. That brings our adjusted book balance to exactly $49,600. The math checks out. We've successfully reconciled. Moving right along to section 4, required journal entries. Now, timing differences like deposits in transit and outstanding checks, those resolve themselves automatically when the bank eventually processes them. But items generated by the bank, things like fees and interest, those are never going to magically appear in your general ledger. You have to post journal entries for them. In our October example, you'd post an entry to debit cash and credit interest income for $210. Then another entry to debit bank service fee expense and credit cash for $50. Oh, and remember, all entries arising from this reconciliation must be approved before posting. Finally, Section 5, Key Controls and Risks. Pay attention, because getting the math right doesn't mean much if the underlying controls are broken.
I want you to really think about this question. Who should prepare the reconciliation? This might just be the single most critical question in Treasury management, because getting it wrong, that opens the company up to massive catastrophic fraud.
The golden rule here is segregation of duties. The person preparing the bank reconciliation must not be able to receive cash or make payments. Why? Well, if the person physically moving the money is also reconciling the account, they could easily steal cash and just hide it in the reconciliation as a fake reconciling item. No way. The reconciler acts as an independent check. That independence is the whole point. And to back that up, a second person, like a supervisor or controller, has to review and formally sign off on the reconciliation before the period is officially closed. Here's another major control to watch out for. Outstanding checks that are over 90 days old aren't just an annoyance, they are a massive red flag. Old outstanding checks shouldn't just sit on your reconciliation month after month indefinitely. Usually it means a payment got lost in the mail or the vendor never received it. You need to investigate. From there, you either void and reissue the check or recognize that the liability might have lapsed based on state unclaimed property loss. As you start tackling these, please avoid these common mistakes. First, not reconciling frequently enough. Best practice is daily or weekly. Waiting 30 days makes finding errors incredibly difficult. Second, the temptation to ignore small differences. You might be tempted to say, oh, it's only a $3 discrepancy, it must be a rounding error. Actually, scratch that, never do that. Writing off small differences is exactly how small fraud starts. To an auditor, a $3 discrepancy is like a loose thread on a very expensive sweater. Pull it, and the whole thing might unravel. Every single difference must be explained. Also, don't let those old checks accumulate. And never let one person do everything. Remember, timeliness is key here. The reconciliation should be completed within 5 business days of period end. If you remember the golden rule to independently find and explain every single dollar, you're going to be in phenomenal shape as you tackle your month-end close. Today, we really drilled deeply into the mechanics of verifying our past transactions. Next time in Module 05, we're going to zoom out and explore cash forecasting. Because once you know exactly where your cash is today, the real question becomes, do you know where it will be tomorrow? See you in the next explainer.